Okay, so now let's talk about the trade discount and how that is being applied. So let's take the example of a company whose name is Home Depot, and Home Depot sells specialized commercial lighting fixtures with a list price of $1,000 each to a major contractors. The stores offer trade discount of 40% and 10% on large orders. So basically, if someone places a large order, then the discount there will be 10% or 40% as mentioned here. Now we need to calculate what are the accounts receivable balance if 100 fixtures are sold on credit. So basically we can say total list price will be how much? Total 100 units are there, as you can see, and each unit's price is $1,000. So that makes it to $100,000, which is the starting retail price. This is the maximum price at which they can charge. Now they give a trade discount of 10%. So the first discount is 10%, which is given as a trade discount. So that brings it as a 40,000. The first discount is taken off the list price. Now the discount has been given. Then we can say that if some person has taken this 40% discount, the remaining balance would be 60,000 here, as you can see. Now what happens is, like, if the second discount, which is of 10%, so this 10% additional discount will be on the balance 60,000. It won't be on the $100,000. So this 10% will show the results of $6,000, as you can see, which is 60,000 into 10%, making it $6,000. Then we can say finally our closing balance will be net amount of both of them, which is $54,000. So what will happen, that the Home Depot will record these sale transactions at a accounts receivable of net $54,000. So this is an important thing to know, that in the case of uh, trade discount, we should always record our accounts receivable at a net balance. So that is the essential thing. It's like if you go to a mall for purchasing any clothes and you see there is a 50% off on the clothes. So what happens, if the cloth is worth $100, then MRP is $100, then out of that you know that 50% is off. So the store will always record that as a $50 price instead of $100, because they know that this discount will be given to each and everyone. So let's see the textbook concept of this trade discount. So basically we can say this trade discount is also known as the quantity discount, because higher the quantity, higher the trade discount. They are also quoted as a percentage, just like 10%, 5% and 2%. And when the sale is recorded, the sales revenue and accounts receivable are recorded at net amount, as we saw that this 54,000 was recorded at net amount after deducting any discounts. And then we say if multiple trade discounts are offered, a series of discounts, just like in our this example, there are two discounts, 10% and 40%, sorry, 40% and 10%. Then what happen, then they are applied sequentially, one after the other, which means that we don't simply add the percentage together, because see, if you add these percentage together, then you would say that overall, if you say that this is a 50 percent discount, then this $100,000, if you apply 50%, then balance amount will become 50,000 here, right? But it's not 50,000, it's actually 54,000. Why? Because the first discount is applied on $100,000, then the second discount is applied only on the balancing amount. So this is the overall concept, that the discount, where it was, yeah, the discount of sequentially should be applied one after the other, as we saw here. Now I have made another example for sequential discount. It's like if the list price is $1,000 with the discount of 10% and 5%, then first discount will be applied on this $1,000, making it $900, and then the second discount will apply on this $900 new value, that, and the discount is 5%, making it $855, which is the final amount here.